The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. Today we're going to be doing a follow-up episode on our analysis of the One Big Beautiful Bill that has been recently finalized. We'll do some updates on the provisions specifically for individual income taxes. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you.
Well,
it came to be.
I was slightly skeptical partway through, but not only did it get passed, they met their 4th of July deadline.
It was in doubt,
but
all the way to the end.
Yeah.
Honestly impressive. I mean, that's some top-tier legislating.
Didn't it pass in like the middle of the night or something?
Yeah,
too?
it was weird.
Yeah, I don't know when.
Maybe that happens more than I...
Who knows?
I think the House passed in the middle of the night, but
Okay.
the Senate passed, I think, I don't know, during the day, and then it went back to the House, and then
Right.
it was passed on the 3rd in the House.
Okay.
But yeah, they were reading, they read the bill, like, took them hours.
And it didn't someone, that was kind of like it was like a filibuster thing. They made them read it like in its entirety on the Senate floor.
Yeah, I think for the Senate they did that, and then they were able to get it passed on like a Monday, I think, and then it went into the House, and then someone did another filibuster for like 8 plus hours, and then they voted on it, and then it passed. So
There we go.
in the House.
So that means exciting stuff for us, though. That's what we get down to. So we love tax law changes. It keeps our job interesting, doesn't it?
Yeah, it's been really interesting reading the law and trying to figure out how the IRS is going to enforce some of these things.
Yeah. So we talked about a lot of this stuff. I mean, there's a lot of things that were in the initial bill that have made it to the final one. A few changes here and there, but we'll try to hit on the key points and what it's actually going to be.
Yeah. The last episode was just the House-passed bill.
Yep.
What we're talking about today is just the final bill that was signed.
Yep. So I went to the Senate. They made a few changes, and here we go.
Mm-hmm.
So we'll jump right in. One thing that everybody's going to be interested in is the standard deduction rates, exemptions, and AGI items. So tax rates from the TCJA are essentially made permanent. So individual rates are 10, 12, 22, 24, 32, 35, and 37%. Estates and trusts are 10, 24, 35, and 37%. So, yeah, I mean, that's what we've been used to for the past several years. Those brackets are all the same. So that's nice. We know what to expect on that. Also, they've made permanent the increased standard deductions, and they've also increased them a little bit. So 2025, it's been increased to $31,500 for a married filing joint, $23,625 for head of household, and $15,750 for singles or married filing separate. And then for tax years 2025 through 2028, they there's an additional $6,000 standard deduction for seniors. And you have to have a modified AGI of $75,000 for single or $150,000 for married filing joint.
Yeah.
So there's a lot of numbers for you. The most interesting new thing is just, I think, that $6,000 standard deduction that'll end up phasing out in 2028. It'll go away.
Yeah. It was just kind of to help appease one of the campaign promises of not taxing Social Security.
Yeah, and that's a way to do it.
Yeah.
You know, and
just adding a deduction for people who get Social Security, essentially. So another thing to kind of make make on a promise during a campaign was qualified tips deduction, which was a very popular provision when people were campaigning.
I mean, everybody was campaigning on that idea. So I guess no surprise that it actually came to fruition, but
yeah.
I think a lot of jobs get tips. It's an easy way to be popular, right? I mean,
yeah, absolutely.
So the way that it was, so the House didn't have a lot of guidance on how they were going to enact this rule and what it meant, no tax on tips, but the Senate kind of wrote it out clearly of what it actually means. So you're just claiming a $25,000 deduction for qualified tips received in tax years 2025 through 2028. Qualified tip just means any cash received in an occupation that customarily and regularly receives tips on or before December 31st, 2024. So, which is kind of funny. So
that's a key.
Yeah. So in occupations that would normally get tips before 2025, essentially, you're able to claim this. And it's not, and when it says cash tips, you might think, oh, it has to be cash. But it's like, it could be just a tip, could be cash, or it could be through a card or whatever.
Right.
But it's in essence, you're paying someone outside of the regular like fee of like the bill, right?
This is a boon to our restaurant, the restaurant lobby,
or
maintaining
bartenders
maintaining that American tipping system,
the tipping culture,
which we're all a little frustrated with from time to time when you check out and everything says add a tip now. But it's those restaurants, bartending, maybe housekeeping,
beauty services,
all those things that we're used to tipping for, right? And expecting tips.
And they put that caveat for customarily and regularly received tips, like occupations that have that before December 31st, 2024. So people can't just like start changing the business like our fee now.
We're going to change accounting to this weird tipping model.
Yeah.
I'm so glad they added that. I was like, when they were first campaigning, I was like, tipping is going to get so much worse.
Yeah. Well, and now the Treasury must publish a list of such occupations no later than October 2nd, 2025.
So we'll have some clear-cut guidelines.
And so now you might be thinking, well, how is this going to be like reported? So it's going to be on your W-2, and your employer has to report you should have always been reporting your tips on your W-2. So now hopefully employers are going to be cracking down on that more. And so it is still subject to FICA tax, which is like Social Security and Medicare. And your employer will also put like what your occupation is on your W-2 as well to make sure that you're part of that list that the Treasury is going to be putting out. Interestingly, it also applies to non-employee individuals, trade or businesses, as long as your gross receipts, so your income essentially, is greater than your deductions. So I have a couple of in-laws who are in cosmetology, essentially. Mm-hmm. And in the beauty industry, there's a lot of tipping as well. But they're not like employees necessarily. Well, they're not employees.
They're self-employed.
They're self-employed, right? And so this still can apply to them, which is...
Yeah, or like, say, random example, dog groomer.
That is true.
You had a dog grooming business. I think people tip a lot. You do a good job on Fido's, haircut. Put some bows in the hair. Smells good. Yep, you're gonna get that tip.
We'll have to see if they're on the published lists.
Yeah, hopefully.
Dog grooming is on there.
We're gonna have to.
We'll reach out. We'll reach out to the lobby. I think there's a pretty big group.
That's a big lobbying group.
It is.
Dog Groomers of America.
Right next to oil and
pharmacies.
Yeah.
Should apply to them.
Yeah, so we'll see if that makes it on the list. But yeah, so that goes into effect January 1st of 2025. So if you are an employee or if you're self-employed working in these kinds of industries, it might be beneficial to, especially if you're self-employed, break out your income of like your regular rate income versus your tip income.
Yes.
And if your employer doesn't report it on the W-2, you have to report it on a Form 4137 when you file your tax return, which is just reporting what your income, what amount of income should be subject to FICA taxes, essentially. And it's a deduction, right? Not a credit, and it applies if you itemize or you don't. So even if you take the standard deduction, you can still get this.
Yep.
And it's not a blanket 25 grand. It's like
right.
It's up to.
Up to. So
Right.
if you had under $25,000 in tips, which will probably cover most of those. I mean, a lot of like your servers or things like that, right? You're probably gonna, it'll probably fall under $25,000 in tips, maybe. I don't know.
Yeah.
And then
Depends on where you work.
I guess it depends on where you work.
Yeah.
And then, but you have to have, if you want the 25,000, you have to have at least 25,000 in tips.
Yeah. If you make $10,000 in tips, you don't get $25,000 deduction. You get $10,000 deduction. So
and it's a good point, like you said there. It's a deduction, not a credit. It's a deduction above the line, though, or essentially whether or not you itemize.
Mm-hmm.
So that's unique. We don't have many of those, right? As things have currently stood. There's a few new of these items now with this new bill. So whether or not you take the standard deduction, if you get these qualified tips, you can take the deduction.
And married taxpayers have to file jointly. So you can't do married filing separate.
Oh, that's unique.
To claim this?
Yeah.
Oh, that's so interesting.
There's quite a few, actually, that are like that. You have to file married filing jointly.
Oh, that's
so. It's just another reason why you should never do married filing separate.
Yeah, there's very few times where that makes sense.
Yeah.
So even
when you're in a happy marriage, there's very few times where
yeah, that's a good point.
Yeah.
Okay, so similarly, these two go together. So there's another deduction, qualified overtime pay deduction. These two I kind of lump into a similar bucket. They're kind of similar items. So starting in 2025, so 2025 through 2028, there's going to be available a $12,500 or $25,000 married filing joint deduction for qualified overtime pay received. There is a phase out on this when your modified AGI is over 150,000 single or 300,000 married filing joint. So the interesting thing is, this is qualified overtime compensation to an individual that's required to be paid overtime under FLSA, Fair Labor Standards Act. So this is like a federal required overtime payment.
Mm-hmm.
So it's not going to apply to exempt employees, right? So professionals, people with advanced degrees are kind of the people. So tax accountants, right?
Yeah.
Us. If we were getting paid overtime by our employer, that's not going to qualify.
Right.
So
They're pretty much salaried individuals.
Yeah, salaried individuals. Yep. So we're talking your hourly employees who get that 1.5 overtime pay, and it has to be included on your W-2 or a 1099 NEC, and that kind of brings up, it's kind of a weird thing to spell that out in the bill, that this can be reported on a W-2 or a 1099, because how does a non-employee get paid overtime?
Be required to be paid overtime.
And be required to be paid overtime.
Right. I mean, they're not covered under the FSLA.
Exactly.
Thing, right. So.
Yeah. So we're hoping.
And there are notes that this is an area of known concern to the accounting world. They're like, wait, this doesn't make sense. And so the hope is the IRS, the Treasury Department, will come up with some guidelines on what that's about. We talked about it for a few minutes before we started, and we still aren't quite sure how that's going to apply to a non-employee that's receiving a 1099.
Because it opens the window, or the door to it. But under labor laws, independent contractors aren't, subject to those.
Exactly.
It's not an employee under the Fair Labor Standards Act. So.
The overtime has to be included on the W-2, so that's interesting. So presumably there's going to be a new line on the W-2
Yeah, or
that shows overtime.
yeah, or a
specifically.
detail. Like sometimes
Yeah,
on your W-2,
yeah,
there'll
yeah.
be like a detail section.
Yeah.
Could be there. I'm not really too sure what a 2025 W-2 is going to look like, but
Yeah.
with all these changes.
So there may be something new. It's going to have to be there. Similarly to the tips deduction, married taxpayers must file married filing joint in order to receive this deduction.
Mm-hmm.
And similarly to the tips, this applies whether or not you itemize or take the standard deduction. You can take it above the line, get that deduction. It's a deduction, not a credit.
Correct.
So,
And similarly, it's with the tips and the senior $6,000 standard deduction. It's from 2025 to 2028 tax years.
yep. So we'll see what happens in 28. You know, it'll be a new world. Things change fast.
Yeah.
It seems. And maybe they'll extend it, or maybe it'll just go away. Who knows?
Yeah. Could just fall off the face of the bill.
Yeah.
But interesting enough, the next deduction that we're going to be talking about that, again, does not matter if you itemize or not, is the car loan interest deduction. So I don't know if many people talked about this on the campaign trail or if this was even talked about.
I don't remember hearing about this at all.
Yeah,
It was passed, and it was just kind of something in there.
Yeah, so it kind of caught us off by surprise. But so car loan interest deduction, you get a deduction of up to $10,000 for interest paid or accrued on post 2024 loans for purchase of qualified passenger vehicles for personal use only. Like you're not getting this for business, but if you're buying a car for your business, the interest would be
Deductible anyway.
anyways, right?
Right.
So, but this is for personal use, deduction of up to $10,000. Interesting enough, post 2024 loans. So this is for cars or loans essentially created in 2025. There is a phase out though if your modified adjusted gross income is over 100,000 or 200,000 if you're married filing jointly. You don't need to itemize. Qualified passenger vehicles just generally includes like cars, minivans, vans, SUVs, trucks, motorcycles, the final assembly of which occurs in the United States. Again, it's tax years 2025 through 2028. And in order to get this on your tax return, you're going to have to report the VIN of your vehicle on your tax return. So if you want to take this deduction and your taxpayer comes back to you and says, I need the VIN, you should give it to him.
Yeah, give it to them. And this isn't going to be for your recreational vehicles, right? It's not going to be for like
ATVs. Is that?
Yeah, not going to be for your ATVs, your side by side, and things like that. I question maybe an RV. We'll have to look into that. I'm not sure.
It says qualified passenger vehicle. I don't know if RV qualifies under that.
Probably not.
Yeah.
Would be my guess. But anyway, something.
And it's not. It does also leasing. It doesn't apply to leasing.
Has to be a
true auto loan.
loan to own.
Yeah.
Yeah.
It's interesting. The final assembly in the U.S. It's similar to what the EV credits had that same distinction, right?
Yep.
So it's
Yeah.
something to look at. If you're buying a car.
Yeah. And with the EV credit, the IRS had a list of cars that
Yes.
applied. So we might get that with the IRS, a list of vehicles.
I'll try and link it in the show notes, but there is like a website that I've used before where you can put in the VIN and it tells you where the final assembly was that we use when we're trying to see if cars qualify as well.
Yeah. That being said, a lot of manufacturers
Do the final assembly.
have the final assembly here.
Yeah.
So this will qualify a lot of cars.
Yeah.
So interesting. That's a win for the auto manufacturers. Okay. Let's move on to below the line, itemized deductions. We'll start with the state and local tax SALT deduction. This one was a hotly debated and contested item for lots of reasons, right? I mean, so the TCJA limited severely the state and local tax deduction, limited it down to a maximum of $10,000. A couple years after that, some states figured out a workaround called the pass-through entity tax election, right? So all your pass-throughs, partnerships, and S corps could elect to pay tax on behalf of the owners, and so thereby, getting a deduction for the state taxes paid. That made some people unhappy.
So, there's a loophole.
There's a loophole, right? And the reason for cutting the SALT deduction was as a revenue generator, so to speak, right? If you can take less of a deduction, that's more tax. That's more tax paid. Anyway, it's been updated. So for 2025 through 2029, the maximum deduction has been increased to $40,000. So that's a pretty big increase.
Yeah.
And it increases until 2029.
Yeah, 1% over the previous year's amount, 2027 through 2029, and then it's fixed until 2030, and it reverts back to $10,000. Now, interesting to note is that the deduction will be reduced by 30%, not below $10,000 of excess AGI over $500,000, and then that increases each year until 2029 again. So if your AGI is over $500,000, you're going to get a reduction in the SALT deduction, and but it can't be limited to less than $10,000.
Yeah.
Interestingly enough, so there was a lot of talk about whether or not they were going to remove the loophole of pass-through entity tax payments, PTE, and they did not.
I think we said in our last episode it seemed like they were going to at the time.
Yeah,
I mean,
that
was
was the thought. It was.
Under the House.
It was in the original bill that was sent to the Senate.
That was the original plan. That's been removed, so PTE payments are still full go. So if you made payments in the past, nothing you have to, or you're making payments this year, you don't have to worry about it. Nothing weird you're going to have to do.
Right.
Yeah, as long as your state still allows it. Because
Yes.
it was the state passed. The
Yes.
state allowed you to do it on the entity level.
Which most states are all incentivized to do so. I don't know why they wouldn't
Right.
make it easier for people to pay you, right?
And most states have passed some, and I think some didn't, maybe thinking that they were going to go away anyway.
Yeah, we'll probably see more.
And so I'll be curious to see if some of those holdouts are go ahead and pass it as well now, seeing that it's going to continue on.
Yeah. Well, and it's interesting that it just reverts back to $10,000 in 2030. So are we going to have to go through this?
Yeah, this will
All
probably
over
be
again,
something
yeah.
that's
Probably someone else will campaign on it.
contested and debated for a while.
Yeah.
Yeah.
But
Yeah.
so the next itemized deduction that we're going to talk about is mortgage interest. So the lower debt amount of $750,000 for your mortgage interest loan or your loan on your mortgage is made permanent. So if you have a mortgage loan that's greater than $750,000, then your itemized or your interest deduction is limited. So that was made permanent. It was lowered from $1 million before the Tax Cuts and
2017, yeah.
Tax Cuts and Jobs Act lowered it to $750. Now that's made permanent, which is like now with the housing market the way that it is,
It's weird.
there's a lot of houses that are over $750,000.
There are. Yeah.
Plus, I mean, it's because it's not just on a single loan. It's like if your combined
Total
If
indebtedness.
your total indebtedness of mortgage is over 750, then it's limited.
Yeah, but then they
It is interesting.
did this caveat of mortgage insurance premiums are now treated as qualified residence interest again. So in 2022, mortgage insurance premiums changed under tax law to not be itemized anymore. You couldn't itemize that as a deduction, but now it's back.
Okay.
But it's only effective after December 31st, 2025. So starting in 2026, mortgage insurance premiums will be treated again. But even again, we're still hitting that 750,000 threshold. So it will be nice for those who, and if you don't know, mortgage insurance premiums are you just paying an insurance premium until you pay 20% of the price of the home, essentially.
Yeah.
So if you down pay 20% of the home, you don't have to pay any mortgage insurance premiums, but if you don't, then you have to.
Yep.
So that's kind of throwing a bone, I guess.
Yeah, there's something there. Yeah, it's not surprising. There's tons of really expensive homes in Utah, you know.
Yeah.
And so,
Well, there was some analysis that said by the end of the decade they thought the average home price in Utah would be like 750 or like $1 million or something. Which
average.
yeah,
That's wild.
Yeah, that's insane.
but
So
it's like, I mean, I could believe that by the end of, I don't know, by the end of like most of these provisions expiring, this 750 limitation is actually just the average home price in a good amount of states, right?
yep. So interesting on that one. Next thing, and maybe we should have included this in our first section, but the charitable contribution deduction. So some of you who were filing taxes during the pandemic, you might remember they threw everybody a little bone. If you made charitable contributions, you could get a $300 or $600 above the line deduction for charitable contributions paid. They've brought that back, but now, beginning in 2026, an individual who does not itemize can deduct up to $1,000 or $2,000 married filing joint on cash charitable contributions made during the tax year. So, yeah, nice little incentive to give to charitable organizations.
Mm-hmm. Yeah, and it's nice because the standard deduction is so high anyways,
Yep.
right? And so you have to have a lot of mortgage interest and
State
salt
tax,
and
yeah.
charitable contributions to get that. So if you can just get this charitable contribution, whether you itemize or not, that's nice.
Yep.
Going next on more itemized deductions. So miscellaneous itemized deductions. If you filed taxes pre the Tax Cuts and Jobs Act, so essentially before 2018, you might have remembered miscellaneous itemized deductions, where they talked about like unreimbursed employee expenses or investment advisory fees, stuff like that. Those were taken away in the Tax Cuts and Jobs Act, and it was only temporary. They're supposed to come back after this year. However, with this new bill, or the one big beautiful bill, the temporary repeal is now made permanent. So they're permanently gone. However, eligible educators now can deduct expenses paid or incurred to purchase books, supplies, computer equipment, and supplementary materials. This is anyone in kindergarten through 12th grade, teachers, instructors, counselors, coaches, principals, or aides that worked at least 900 hours during the school year. They can now itemize this, essentially. And it's effective after December 31st, 2025.
So starting 2026.
Yep. So starting in 2026, educators will be able to deduct these expenses. Previously, you could do this as like a above the line deduction. I think the max was like 250 or something like that.
Yeah, it was really small.
It was 300
Or 300
per educator in the household, right? So if you were a married couple of two educators, it would be 600. But
Yeah. So now there's not that ceiling, but now it's lumped with itemized deductions, so you have to itemize in order to get it.
Yep. Okay. This last thing with the itemized deductions, I think, is interesting. So taxpayers' itemized deductions are going to have a phase out. So they'll be reduced by 2/37ths or 5.4%. We did the math on that. 5.4% of the lesser of their itemized deductions or taxable income that exceeds the dollar amount at which the 37% tax bracket begins starting in 2026. So your really big earners are going to start to see their itemized deductions reduced. And that's just, a little way to start
Clawing back some revenue.
Yeah, clawing back some revenue. This might look good on paper or something, and I'm sure there is some revenue you could attach to it, but the wealthiest individuals in this country aren't getting their large deductions through Schedule A anyway, right? But
Well, there's already so many limits on it, right? Like
yes,
the SALT cap, and then like a lot of high earners,
your interest,
your mortgage interest is
that's limited.
a lot of it's like a lot of it's phased out.
So you're talking about charitable contributions mainly, probably, and Anyway, interesting, and something we'll see from time to time. But
yeah, we'll see how much of a difference that actually makes, how much it affects those. But
they got to find some way to, try to balance out the bill
yeah,
in some reasonable manner, I guess.
mm-hmm.
But yeah,
Yeah, so that's everything with itemized deductions. There's quite a few, which was interesting. So now we're going to go to credits. So firstly, the child tax credit, that was increased to $2,200 per qualifying child under the age of 17, starting in 2025. If you remember, before it was just 2,000, so now they're upping it to 2,200, and it's now adjusted for inflation. That number, 2,200. So that'll be nice.
I like that. I think more things should be adjusted for inflation, so I'm glad that they said that to begin with.
I think in this bill there's a lot more things that are being adjusted for inflation, which is good.
Smart.
Yep.
And then there's the other child credit or whatever, that other
dependent credit.
Other dependent credit, $500 stays. And then there's just some modified adjusted gross income thresholds for the child credit that were made permanent as well. So just the biggest thing was just increasing your per child credit under the age of 17 to be 2,200. So
Nice.
that's nice. I'm having another child this year, so that'll help.
Yeah, great. Okay, so along with this, like we said, some revenue generators. They've gotten rid of some credits. We can think of these kind of as your green credits, right? So energy efficient home credit, gone as of December 31st, 2025. Residential clean energy credit, again, gone as of December 31st, 2025. Our clean vehicle credits, both the new and the previously owned clean vehicle credit. So what was it, $7,500,
Yeah, $7,500 for the new.
for the new, and then the $4,000 max credit for the previously owned. Those credits are gone as of September 30th, 2025. So that's interesting. They're shutting that down as soon as they can.
Mm-hmm. Yeah. So if you're gonna,
Here's the thing, I don't know, who knows what it's going to look like, but if you're looking at buying an EV in the near future, you might want to do it before the credit goes away. Conversely, who knows? I think a lot of the EV prices have the credit baked into them. So maybe the overall prices will just fall after the credit goes away too. Who knows?
supply and demand.
Yep, that's exactly right.
Who knows?
But that's an interesting one, that September 30th deadline. Yep, so credits on the EVs are going to change.
Yeah, these are a lot, actually. I feel like and these were credits that a lot of just everyday people could get.
Yeah, that's true, and that's what's kind of sad about those going away, right? It's like,
Like, these are more individual based.
yeah, and not necessarily like you didn't have to be ultra wealthy to take advantage of these credits.
Mm-hmm.
Right.
And so, anyway, gone.
Something of note.
Yep.
Something to note. So might as well just start getting those gas guzzlers again. Just kidding. Next, credit. So you get a credit for contributing to a scholarship granting organization. So after 2026, individuals are allowed a credit for qualified contributions to scholarship granting organizations that provide scholarships for qualified elementary and secondary education expenses. It's limited to $1,700 and cannot be counted as a charitable contribution at the same time. So you can't get a charitable contribution as well as this scholarship granting contribution. Or
no double dipping.
Yeah.
Yeah.
After 2026, scholarship amounts provided to taxpayers are excluded from taxpayers' gross income, and it's effective after December 31st, 2026.
So we've got a while until this actually kicks in. So starting in 2027.
Yep. So hold all your money, and then in 2027 start that.
Yeah.
It's limited to, so it's a $1,700 credit, which can be really good, which is really nice.
Yeah, that's great. And there are lots of people who donate to scholarship organizations. So I think I mentioned before, I volunteer for one, so that's cool. I think that'll make it easier for us to get those donations and get those scholarships out to students.
Yeah.
It's interesting looking at this provision in tandem because didn't they limit like how much you can get in like student loans for undergrad and graduate education? It seems like they're trying to promote more people to donate to scholarship granting organizations and in favor of getting funding from the federal government for your education. I don't know.
Seems reasonable.
Seems interesting.
I like that, but who knows? Yeah, that's cool. Lastly, so the last thing we'll talk about is the Trump accounts.
Yeah.
That's a win for the president to get these named after him. But basically, they're a tax-favored retirement savings account. And so for children born after December 31st, 2024, and before January 1st, 2029, so 2025 through 2028 children who are U.S. citizens, the government's going to seed a savings account for them with $1,000. They're just testing this out, so they're calling it a pilot program. They're going to see how this works. It's essentially a new type of individual retirement account. It's got separate rules from a Roth IRA, while it's maybe covering kind of a similar subset.
Yeah, it's like similar to a Roth.
But it's its own new thing.
Yeah.
No distributions will be allowed at all before the first day of the calendar year in which the beneficiary turns 18. So they're just going to sit and grow for 18 years at a bare minimum. The distributions will be allowed for like education or other qualified items at that point. And then one interesting thing is these account funds will only be invested in whatever are determined to be eligible investments. So it's not like you're going to be able to invest this in whatever you want.
Right.
And then they are open for contributions, but limited to $5,000 per year. And that number will be adjusted for inflation over time.
Yeah. And another thing, I didn't write it in our script, but there are options for your employer to
Contribute
to your Trump accounts as well. So I think
like for the Trump accounts of your kids?
yeah.
Okay.
Yeah, and I believe the maximum is 2,500. I could be off, but it's something like that.
I think one of the biggest things to note there is the government will be putting in the first $1,000.
Right.
Because we've got IRAs, we've got 529s, we have
These types of accounts have
that isn't new, but it's I think the government putting in money that's interesting, and so good. Congrats for all those kids getting born now.
Yeah, and like this, I mean, they said it's a pilot program, right? So it could continue after 2028, but they might not continue to fund,
Right.
New kids from indefinitely. It might just be to get us started right now.
Go and have a kid.
Yeah, you are on the ropes about it.
Yeah, that's what they're doing. They're incentivizing everyone to have,
Yeah.
which could
job,
be a
Spencer.
thing. Yeah, well, yeah, 3, and we'll see how much after that. But yeah, a lot of changes for the individuals. Writing the script, reading all the law was time consuming and just a lot. And we didn't even cover everything that.
No.
And we, there's a lot of niche things that we don't cover just for the sake of not everyone,
Right.
a small subgroup of people might affect.
Yeah, this was just what we thought was the most relevant items.
For the majority of people. And we tried to go in depth on some of the things that's definitely new. But if you have any other questions or, if there's something that we didn't cover, for sure, let us know.
Yeah. Send us an email. Reach out to the firm, whatever.
I'm on LinkedIn.
Yeah, find us.
But we'll do another one for businesses. But this was just for individuals.
Yeah.
So thanks everyone for listening.
See you on the trail.
For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.